Hey everyone, thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by TraderVate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can also trade these on the DOM on TraderVate's main platform as well. They're the great way to get exposure to the futures market with limited risk. You can go to placeyourtrades.com, get the TraderVate app for free. I also write a weekly blog and daily pre-market overview on the markets that you can subscribe to at placeyourtrades.com. I will be doing a summary of this episode with my key takeaways that will be available to download as a PDF. So if you're interested in getting this PDF, please click on the link in my feed or visit placeyourtrades.com/spaces to sign up for it. And the PDF overview will be available and mailed out to anybody who signs up. And now to introduce our guests. First, we have Jim Bianco. Jim is president and macro strategist at Bianco Research LLC. Since 1990, Jim's commentaries have offered a unique perspective on global economy and financial markets. In 20 years at Bianco Research, Jim's wide-ranging commentaries have addressed monetary policy, the intersection of markets and politics, the role of government in the economy, fund flows, and positioning in financial markets. He also appears regularly on CNBC, Bloomberg, and Fox Business. Prior to joining Arbor and Bianco Research, Jim was a market strategist in equity and fixed income research at UBS and an equity technical analysis at First Boston and Shearson Lehman Brothers. Next, we have Keith Dicker. Keith is a CFA. He founded IceCap Asset Management in 2010 and is president and CEO. He has over 20 years of investment experience as a portfolio manager, focusing on wealth for clients all over the world. He started his career in Halifax as a portfolio manager with a large Canadian bank where he managed high net worth portfolios on a discretionary basis. Next, for 10 years, Keith managed portfolios for an offshore bank in Bermuda as the senior portfolio manager and head of global equities. He was responsible sorry, my cat's jumping in my way. He was responsible for global investment strategies, including asset allocation, equities, fixed income, commodities, and alternative investment and multi-currency. And before we start, just as a reminder, this material is presented for solely informational and entertainment purposes and is not to be construed as a recommendation, solicitation, or offer to buy, sell, or sell long or short any securities, commodities, or related financial instruments. Please contact a licensed professional before making any investment or trading decisions. And now that we're done with the introduction, let's go ahead and start. And how I do this is in a round. So we'll do a couple round of questions for each of you. Also, feel free to interject if you have a comment about anybody else's comment. We can make this as round table as you want it to be. And with that, we will start with Jim Bianco. So Jim, let's start with the yield curve. This is, I believe, the longest or one of the longest periods we've been inverted without a recession yet. So are we headed for a recession? Is it this time it's different? Are we going to uninvert? And where do you think yields are headed? That's a loaded question, I know.
Yeah, down, up, down, down. There's my answer for you. But seriously, yeah, you're right. The yield curve has been inverted now for, about a year. The yield curve I'm referring to is the 10-year, 3-month yield curve. It inverted November 22nd of last year. This is the longest inversion that we've seen in a yield curve since the mid to late 1970s. So this has been very, very long that the yield curve has been inverted like this. We seem to be in the process of uninverting the yield curve. Uninverting the yield curve is otherwise known as a bear steepener, which is fancy talk, bond talk for all interest rates are going up, but longer term interest rates are going up faster than short term interest rates. If we wind up uninverting the curve. That means it gets back above zero, meaning long-term interest rates become higher than short-term interest rates for the first time in over a year through a bear steepener. This will be the first time in at least 50 years we've done it as a bear steepener. We usually do it as a bull steepener, which means rates are falling, short rates are falling faster. That we understand. That's the Fed panicking. We're going into a recession, cut rates like crazy. That's how you uninvert the yield curve. But this one, in the bear steepener with all rates going up, long rates going up faster, I think it has a whole different meaning to it. And this is probably why the yield curve isn't working. And that whole different meaning, I believe, is we have inflation. We have an inflation problem. And that's why you're starting to see long rates go up. Why are long rates going up faster in the last month or so? The conventional wisdom will tell us that it's about supply, that there's a lot of supply. I got in this business in 1985. You can go figure out how old I am right there from that. The first week I was in this business, I was told that there was so much treasury supply it was going to crowd out the market and interest rates are going to go up. 38 years later, we're saying exactly the same thing. It was true then, it's true now, it'll be true tomorrow, and it'll be true every day for the rest of our life, that the treasury is going to be issuing tons of supply. I think it's more about inflation. Austin Goolsbee, who's the Chicago Fed president back on October 5th, said it's a puzzle, and I'll paraphrase what he said, that last year when inflation got to 9%, the 10-year peaked at 4.2%. And this year with inflation under 4%, the 10-year is at 5%. It's not a puzzle, Austin. Last year, you were raising rates at 75 basis points a meeting. The market didn't need to do anything. This year, you have said that you're done and you're going to let the market do the work for you. Okay, the market is doing the work for you, and it's not done. It's not done doing the work for you. It's going to keep pushing rates higher. How high do they think they're going to go? I'll take the Fed for their word that they're higher for longer, which means that the 5.25 to 5.5 funds rate is not going to be cut anytime soon. The highest point on the yield curve right now is the 6-month bill at 550. So where are we going? If we're going to uninvert the curve, we got to go, the 10-year and the 30-year have to go to at least 551, and probably higher than that. So I've been a bear for a couple of years on bonds. I remain a bear on bonds, and I don't see, at least in the short term, anything to tell me that there has been a capitulation in the bond market, because the way I look at it, most of the data says everybody's long. I mean, to be honest with you, everybody's long getting their brains beat in, and they're doubling down on this bad bet, and they're hoping that this bad bet will work for them. So that's been my take for the better part of the year, actually for a couple of years on the bearish part, but everybody's been long, and I'm waiting out a capitulation on the bond market, and I'm going to stick with that right now. So just to reiterate that last question, the yield curve is not working because this is a bear steepener to potentially uninverting. Every other uninversion has been a bull steepener, with the Fed cutting rates because they were panicking that the economy was going down. This bear steepener, I believe the interpretation of that is we still have an inflation problem. And since the Fed is giving up on it, we don't have to raise rates anymore, let the market do the work for us. That's exactly why we're seeing rates go up. I'll stop there.
And then, since you brought up inflation, what are your thoughts on inflation? Do you think the Fed is going to be able to reach its 2% target? As in, are we over the hump and headed for deflation, or is this going to be very sticky?
The 2% target was last cycle. That's over. We're not going back there. We need to recognize, as I like to say, the short answer. The biggest economic event of our lifetime was the global shutdown restart of the economy in 2020. It changed a lot of things. The biggest thing that we're all familiar with that it changed is work from home. And because it changed a lot of things, and technically the way I've argued is it took trends that were in place, like work from home, and sped them up. Nick Bloom at Stanford University he's been studying work from home for 20 years. Now he's very popular. He would say that we were trending towards work from home by at 0.5% a year as an economy. But between 2020 and 2022, 25% of us went home, started doing, and when I say work from home, I really mean remote work. I don't mean 5 days at home. I mean some kind of hybrid remote work thing. 25% of us. So as he likes to say, we jumped ahead 40 or 50 years in the cycle in 2 or 3 years. Now we have to catch up. And so I've argued that the economy is perpetually out of balance, and that and I can explain that later, but in that out of balance means that we're going to have more frictions, we're going to have higher inflation. Not 8, 10 Zimbabwe levels of inflation, but 3, maybe 3.5% inflation versus 2. Why does that matter? Well, the Fed likes to say that the funds rate, its neutral rate, is 0.5 percentage point above the long-term inflation rate. They think the long-term inflation rate is 2, and they say, so therefore the neutral funds rate's 2.5. They're at 5.25 to 5.5, so they've got plenty of tightness in the market. I think if we were to adjust that the neutral funds rate's to 3 to 3.5, 0.5% above was what you did in a QE period. You should be 1 to 1.5% above the long-run inflation rate. So what I'm looking at is a neutral funds rate of somewhere between 4.5 and 5. Now we're 5, 5.25, so we're tight, but we're not nearly as tight as everybody thinks. And that's why tomorrow we're going to report GDP. It should be 4%. That's the consensus. I'll remind everybody, in June, the consensus for third quarter GDP was 0, and now it's 4%. That is a massive change in the outlook of the economy in 90 days, meaning we don't understand this economy at all. We just do not understand this economy because it's not the same economy as 2019. That's why I think we get the initial claims numbers wrong. 18 of the last 21 months, payrolls have beaten, what I just said with GDP. We do not understand this economy. It is stronger than people think. It has got more inflation. That means we're going to have higher rates. And I'll just tease you, that's not necessarily bullish for stocks, because stocks have to contend with a do-nothing option of 5.5% on money market rates, and maybe higher if on bond funds if they continue to move higher. So you might say, yeah, the stock market, the economy's doing good. We got earnings, and maybe you're going to say, so what? I could get 2/3 of what you're going to offer me in the stock market in a money market fund with no market risk. You're not worth the other third. That's why the stock market's struggling, not because we're expecting a big dive in earnings.
And with that, do you think the Fed has another rate hike this year? It kind of seems like lately they've backed themselves into a pause corner with their comments. Yet the market, as you said, we're expecting 4% GDP. The economy is going strong. So it seems like they are going to have to raise rates again. What are your thoughts on that? And then which camp are you in the soft landing, no landing, hard landing scenario?
A no landing for the last question. No landing, I know that's the metaphor for the airplane. That's what we do 90% of the time. The plane doesn't land. It does not come down. A soft landing. First of all, I would actually argue too, there is no such thing as a soft landing. That's when the plane's 5 feet off the ground about to crash. That every soft landing is the beginning of a hard landing. But no landing just means we just continue to pump out positive GDP numbers. That's what that means. That's what we do 90% of the time. I'm in the no landing camp. As far as the Fed, you're right. They have backed themselves in a corner. They keep mumbling words about long and variable lags. That policy works with long and variable lags. Actually, count me in the short and immediate for policy. The reason that they're not seeing the bite from interest rates, which is what they say is long and variable lags, is because they're not that tight. They're not that tight. I can explain that a little bit later. And the other problem that they have is 18 months after they've started raising rates, they're saying we got to pause and we have to assess what these rate hikes means. Are you going to pause for 3 years? Because 1 or 2 meetings of pause isn't going to tell you anything more than what you know today. You'll have to pause for at least 18 months. at this point to figure out what the rate hikes to date have done. And I think when you do that, you're going to realize not a whole lot. And that's why the economy continues to go. So, yeah, they're not going to raise rates next week. Probably not going to raise rates in December. I'm still of the opinion that there might be a rate hike or two in 2024. Um, and we'll have to see, whether or not that comes about. Last word about 2024, it's an election year. Oh, the Fed doesn't raise rates in election year. Actually, if you look at it, the Fed has a repeating pattern over and over again. It's an election year. We're not going to do anything. Then something happens in the election year, and they do the most extreme things they've ever done in an election year. 2020. It's an election year. We're not going to do anything. Then we have a pandemic. They immediately cut rates to zero, and they do the biggest amount of QE in human history. Um, you know, 2008. It's an election year. We're not going to do anything. We have a financial crisis. They cut rates to zero. They institute QE. They bail out the banks through TARP 20 days before the election. 1980. Oh, we're not going to do anything because it's an election year. Do we have inflation? They take the funds rate to 21 and a half. Oh, and I forgot 1992. Greenspan raised rates in 1992. George H.W. Bush wrote in his memoirs, he blames Greenspan for losing the election. So, yes, the Fed will start January 1st and say it's an election year, we won't do anything. And then circumstances force them to do all the extreme things in an election year. So I'm not saying there's going to be an extreme thing. What I'm trying to say is don't let this idea that next year is an election year think that that's going to change anything. They do it all the time. They move on election years because they're forced to. If inflation is a problem, they'll be forced to move in an election year, and they will.
Excellent. Thank you. And we will come back to you. I'm going to move over to Keith here for a little bit. Kind of wanted to talk about, let's talk a little bit about the Canadian housing market. Obviously, it's what everybody talks about, has been talking about. We saw September prices push up again after falling for 3 months, and it seems like there's no end in sight for this bubble, even with higher mortgage rates. So where does this all end, and where do you see this headed? Another loaded question, I know.
Yeah, absolutely. Hi, Jim. Nice to hear your voice there again. And Tracy. Oh, by the way, listening to my bio earlier and then hearing Jim reference, I think you said 1985. I realized I think my bio might be 10 plus years old, and same with my Twitter photo as well. So I've been around a bit longer than the 20 years in the bio, and that's where we are. But sort of tagging on just a few points that Jim made, and then jumping as well over into the Canadian focus. Now, just a reminder, we're not based in the U.S. We manage money for investors in a number of different economies. But what's happening in the U.S., it is unusual in many ways. But you also have to look at what's happening outside of the U.S. And whereas, the Americans have, the economy is okay, the data points, they refuse to roll over. I think we are going to be that 4% plus number for growth for the quarter we just finished. But everywhere else, it's really starting to slow. It's sluggish. So here in Canada, people may or may not be aware of what's happening up here, but the economy is rolling over. It is slow. This is Bank of Canada Day, by the way. But the growth in Canada, people have to realize that Canada has about 40 million people for the population. And over the last 12 to 18 months, we've taken in about 1.25 to 1.5 million in new people coming into the country, so immigration. So you compare that to California, for example. I think California's lost about 800,000 over that same time frame. So the point with Canada is that a lot of the data points, they may not seem as bad as what they should appear because of what we're seeing here in the marketplace. But a lot of it has been disguised by this huge population surge driven by immigration, which naturally increases demand. So if you can increase the supply of a lot of things and demand is increasing, what happens then? The price goes up. So this housing market we've been experiencing in Canada, it's been completely enabled by several main factors. One is on the demand side by the population increasing. We've also had this now, I refer to it all the time, but the policy reaction from the 2020 pandemic, it's been wrong on so many levels, especially shutting down the economy. And it's not fair to say it, but paying people not to work and whatever. It did not affect the amount of money that was available in the economy. Meanwhile, the supply of a lot of things, it either didn't grow or it actually declined. So that's been contributing to this Canadian housing market story we see here. But just referencing, I sort of want to circle back to some of the comments that Jim made, which I do agree with. Um, so whereas the U.S. economy, it is growing, and some people trying to figure out why is that so happening, it's sort of rolled over by now. What is the Fed going to do, and so forth. Every time the Fed remains hawkish, whether they're hiking rates or not, all the other economies around the world, we're struggling. So we're struggling here in Canada. The European story, it's dismal from our perspective. China is struggling as well. So every time we see more hawkish data points from the Americans, again, it's attracting more and more mobile capital into the US. So into the dollar, is driving it higher. And it makes the other economies weaker. So all of a sudden, here in Canada and elsewhere, the central banks have this decision to make. And I think they like the Bank of Canada is likely topped out now with rate hikes. And even if they do start to cut rates at sometime next year, that could be a policy error then. But as the US remains strong, it's just sucking the life out of the other economies around the world. And from an investment perspective, we think this is fantastic. Being completely objective and neutral, the current global macro setup, we believe it's providing you with a great opportunity to hedge against some of these tail events that could likely occur. And at the same time, continue to produce positive returns. And it's something that we look at all the time. The other thing to consider, let's just shift back up to Canada here for a second, Tracy, is that, and if you're not from Canada, you're going to say, "Wow, this is really interesting. Maybe there's a few ideas with this." Canada has just come off a 40-year period. Same with the Americans. Rates peaked really in 1982, straight down to zero in 08, 09. And then overnight rates were at zero or near zero, for over a decade. So you think about it, you have people now working in the industry for 10 plus years, a full decade, and all they've ever known has been zero rates and quantitative easing and stuff like that. And now that period is over. So as investors, we should be expecting something different to take place as we go forward. But the best thing with Canada is that aside from the oil patch up in Alberta, as well as Newfoundland to an extent, we've never experienced a true national recession before. And because the banking sector in Canada is completely dominated by just a handful of banks, their loan portfolios, I often say they're homogenous. They would disagree, but they really are. And because the number of metrics look at the housing market pricing, based on household income and stuff like that, if Canada does experience a recession, and if it's not one of these soft recessions that they're all hoping for, and Tracy, as you know, hope is not a good strategy for the investment world. But if Canada does sort of roll over into something a bit more aggressive, for the first time in everyone's lifetime, we have the probability of experience a severe crisis up here. And it doesn't mean it has to happen, but the probability of it happening, it's a lot higher than we've seen over the last 40 years. And again, from an investor perspective, we think that sets up a lot of great opportunities for people.
And since you brought up rising rates, particularly out of the Federal Reserve, but also other central banks raising rates everywhere, we're particularly seeing emerging markets get hit with deep losses in stocks and bonds. So is there a contagion risk here? And what are the dangers with this?
Yeah, so we often refer to global risk has been synchronized now. And we put a lot of focus on the narrative of capital flows.
And then I wanted to ask about the yen, because I know that you specialize in currencies as well. But so the BOJ had to step in last week with emergency bond buying operations when JGB hit a new decade high, and I think they just did again today. So do you think, should we be worried about this, or is this contained in Japan? And two, what are your thoughts on the yen? Are they going to have to intervene meaningfully in the yen? I mean, we keep bumping up against that 150 psychological level where everybody gets uncomfortable. And if so, does that put a wrench kind of in the carry trade?
Was that for me or Jim? I missed the first part.
That was for
Oh,
you.
okay. The great thing about the yen story, Lisa, so they really have, Japan has to make really a decision between the bond market and the FX world. And they're trying to do both. So right now, they are getting a gradual deterioration on the FX side. I think they can live with that. Companies will adjust to it as well. And but you would have to expect, and this is our view, that they have to save the bond market no matter what. Because once the bond market, if it does get out of control with, they allow you to shoot higher, that's going to create immediate losses within their pension fund system, as well as on balance sheets, the banks. And people expect that in Japan, if they allow yields to, continue to creep higher, at some point it's going to attract domestic capital to come back home. And if that happens, then that should create another knock-on effect elsewhere. But for the yen right now, and it's just my speculation, I think they're really, looking at both corners of their eyes and trying to figure out, can they hold on longer than China or another marketplace? And again, as with global risk being synchronized, is it Japan that causes things to get a bit funny? And this one, again, if we go back to Jim's comments about the U.S. and economic growth and the Fed remaining hawkish and stuff like that, which I expect they will be. However, the Fed it really is the world's central bank. So back in I think it was 2018, the Fed got stopped out. Remember they were hiking, was it 25 points every second meeting? I think that's what it was. They got stopped out because of the stress that was being created outside of the U.S. So I suspect if the Americans and the Fed, if they stay hawkish into next year, they might get stopped out because of what's happening outside of the U.S. It is this global setup right now, and as an investor, again, embrace it. Be excited about it.
So if I could add to that a little bit about the Bank of Japan. The Bank of Japan is finding out what the Bank of Australia found out 2 years ago, that when you engage in yield curve control, it seems like you do it and initially you get a stimulus boost and everybody pats themselves on the back about job well done. But the problem is when you try and get out of it, the only way you get out of it is you pretty much blow everything up and you wind up undoing all the good that you thought you did by doing that policy. The Reserve Bank of Australia has found that out in a big way, and there's been a lot of central bank turmoil there to the point where Philip Lowe, was basically not reappointed. And during testimonies in the Australian Senate, Australian senators were so mad at the policies of the Bank of Japan, they actually swore at them in the meeting and had to apologize that they were so upset with their bank and tried to pass a law to strip them of their independence. That's your consequence of trying to get out of yield curve control. You blow up your economy and you then get all kind of blowback. I think Japan is trying to find that too. They need to get out of QE. As you pointed out, they can't because if they get out of QE, they're going to create gigantic bond losses. But if they hold QE, they're holding rates at the wrong level. And that's why the market is constantly fighting them. Remember that their target is 0, and it was initially a 10 basis point range. And then when it got to 10 basis points, they said, no, the range is now plus or minus 25 around 0. And then when it got there, they said, no, it's 50, plus or minus 50 around 0. And then when it got there, they said, well, it's still 50, but it's kind of gray. We might let it go a little bit above 50. They're at 85 now, and now they're talking about releasing it again. It is a failed policy, and they just cannot come to admit that it's a failed policy. And the longer they continue to fight this, they're going to lose either way. They're either going to let this policy go, and their rates are going to go up and create losses, or they're going to continue to try and fight the market, and they're going to continue to distort things with the policy. Like I said, when you got into it in 2016, there was a moment there that maybe they could pat themselves on the back that they did a good policy and everything is good and the world is better because we did this. But as Australia found, it's a roach motel. When you try and get out of this, it is nothing but pain and suffering and heartache. And that's the road that they seem to be on in trying to get out of this yield curve control policy. They've got the wrong interest rate. They don't want to go to the right interest rate. They can't keep it at the wrong interest rate, so they have to pretend that they can. And it's just a complete mess.
And we'll continue with Jim. I want to move on to U.S. markets. You did mention that obviously equities are going to have a hard time or will be struggling against higher yields. But is there any scenario that could save this market right now? So earnings, GDP, or is it just a losing battle against the yield rise?
Well, yeah, let's put the market into perspective right now. I tweeted out a couple of days ago, I think over the weekend, a chart that I took the Russell 3000, so it includes large, mid, small cap stocks, took the Magnificent 7 mega cap AI stocks out of it. It's down on the year. As a collective, it's down on the year. At least it was through Friday. And I think it still is as of this moment as well. So if the bear market in stocks ended a year ago, October 12th of 2022, you had about 45 days where you had a really good rally in the market, and then, maybe a little bit longer into late January, and that was pretty much it. And we have seen this market struggle except for 7 stocks. So why is it struggling? And of course, the narrative is we're going to have a recession, we're going to have a hard landing, earnings are going to fall apart, everybody's predicting all kind of gloom and doom. It's the competition. It's the competition, I think, is really what the problem is for the stock market right now, is that people, I've heard this from wealth managers over and over again, the stock market is compelling for all these cases and people look at them and shrug
This space was downloaded via spacesdown.com. Visit to download your spaces today.
their shoulders and go, I could get most of that with no risk in a money market fund. Thank you very much. And that is going to continue to be the problem that it faces. And again, you might argue, but that's not the case. The S&P is up 10% year to date. Yeah, but the other 493 stocks are down. There will be a day, maybe next year, maybe in 5 years, where the average stock will be up 10%, and if you're in SPY, you're down on the year. The flip side will always occur somewhere. We just don't know when. And so I think that the market's problem is going to be higher rates, and it needs to adjust to that. Now, how does it get past it? Strong growth, really strong growth, that you could just kind of out-earning the idea, forgive the background noise, I'm outside, you can out-earning the higher interest rate scenario, that the 8% return that the stock market is supposed to give you over a long period of time. Let me back up. Dr. Jeremy Siegel, who wrote the book Stocks for the Long Run, just put out a new edition of it this year. And I'm summarizing this. But what is the long-term return that the stock market should give you over many cycles, up, down cycles? 8% is roughly it. Look at what we've done the last couple of years. The last 2 years, the stock market's return is roughly 0, even with the Magnificent 7. But in 20 and 21, it was great. And if you average it all together, And even go back pre-pandemic, 8% seems like a reasonable number. I could get 5.5. I could get 5.5 right now with no market risk. I could get almost 2/3 of that gain with no market risk. So the market either has to see interest rates go down a lot, but the problem with that is that the only thing I see that causes that to happen is a recession, or we just need really strong growth and go, no, it's not 8, it's 10 or 11 or 12, because we're going to go into a period of just strong growth full out. And yes, rates might go to 6 or 7, but you'll still want to own stocks. You'll still want to get out of your money market fund that's yielding you 6% and be in the stock market because you see it as a better deal. Neither one of those scenarios I see is happening right now. And so I think we're just caught in this malaise. It's not a story that the stock market falls apart, but it's a story for the continuation of what we see. A couple of story stocks are revolving around AI, are driving everything, and the rest of the stuff is just kind of stuck in the mud, not doing a whole lot, if anything, frustrating everybody. Wish I had a more optimistic story for you in the stock market, but until things change, that's kind of the way I see it right now.
And then I wanted to ask about U.S. banks. Moody's just came out and said U.S. banks could be grappling with at least $650 billion of unrealized losses in their securities portfolio. So what does this potentially mean for the markets?
It is a negative, I think, for the. I think it's more of a negative for the economy than for the markets themselves. I think the banks are suffering from two problems right now. Problem one is what we've termed the bank walk. Again, it gets back to so many things have changed because we've got interest rates right now. And the average bank in the United States has a deposit rate of around 0.5 to 0.7%. And the big banks, like the Chases of the world, are still offering you 0 on your money in your money market account, in your bank account. But we have a new technology, which is mobile banking apps. Now it's not new; it's been around for 15 years. But we pinned interest rates at 0 for 15 years, so it didn't apply. But now it does. So people are now saying, I don't want to. I got, just to throw out a number, I have $250,000 in the bank. Why did I pick that number? Because that's the FDIC minimum. Why don't I move that $250,000 to a money market fund yielding near 5.5% and pick up $14,000 a year in interest income, as opposed to leaving it in my Chase account and getting 0? All I got to do is pull my phone out of my pocket, spend 5 minutes transferring money from my bank account to my securities account to a money market fund. And everybody knows the two things people use their mobile banking apps for are paying bills and transferring money. So that's the one thing everybody knows how to do. Maybe they don't know how to do, iron condor trades in their brokerage account on their phone, but they do know how to transfer money. And so they're doing that, and that's the bank walk. And that's why we've seen the biggest drawdown of deposits in the 50 years we've been measuring the banks, because everybody's moving to money market funds. They're moving to treasury bills directly, or maybe fintech or something like that, to get a higher yield. This is impairing the bank's ability to make profits, because deposits are their cheapest source of capital. And it's also going to constrict their ability to lend. It's not constricting, but it will constrict their ability to lend. And then on the other side of the balance sheet, as you pointed out, they're all long a bunch of treasury securities. This is an artifact of Dodd-Frank. This is an artifact of the financial crisis. We don't want you to buy anything that has a credit risk. We're going to incentivize you to buy things with no credit risk, which is a treasury. Well, okay, you don't want me to take a credit risk. You want me to take a duration risk, is what you want me to do. And then you pinned rates at 0. And so you made every incentive for me as a bank to not only not take credit risk, but take duration risk at the long end of the curve. That's exactly what they did. The incentives you gave them. And then when the rates started going up and inflation created, boom, $650 billion unrealized loss. This is why the bank stocks are and continue to be among the worst performing sectors in the financial markets year to date. And the bank stocks aren't getting better. They're not at the lows of the year, but they're back to near, the bank indexes, the KBW regional bank index or the overall bank index, is lower now than when we were panicking about the banks in March. Now, it made its ultimate low for the year in May. We're not quite that low. But if you said, this is all panic, I'm going to buy these banks in mid-March, you're still at a loss 6 months later because they've never really recovered from that because the bank walk isn't going away. The losses aren't going away. The profitability of banks is being squeezed. Now, last thought for you on banks. Everything I said is a problem for the investor in a bank. It is not the problem for a depositor in a bank. If you have your money in a bank, after you've heard all that, you're not at risk. Your bank is not at risk of failing. Oh, there's 4,200 banks. What does that mean? That means there are some mismanaged banks. There's 4,200 of them. There has to be some mismanaged banks. But that doesn't mean that the entire industry is mismanaged. I am comfortable keeping my money in a bank of any size. I don't think that that's a problem. Ask me if I want to own the stock of any bank or have the bond of any bank and be reliant on their ability to make profits. That's the story that I'm referring to, and that's what I'm pessimistic about.
And then, what are your thoughts on fiscal policy versus monetary policy? Obviously, they're butting heads right now, right? You have you have the Federal Reserve raising rates, and you have you have the government spending like mad, and the Treasury as well. So obviously, we're heading into an election year. The government obviously has no plans to stop spending at this point. So does this affect the Fed's moves at all? And do you see this as a problem?
It is a problem. It may not affect the Fed's moves. The Fed uses a fancy term called fiscal dominance. And what that means is that they will not let the fiscal situation impact policy. Let me put this in general. People say all the time, look at the amount of interest costs that the federal government has to pay. They can't pay it. It's more than the Defense Department budget. I've even run that chart that it's larger than the Defense Department budget and it's going straight up. Correct on all score. So then they say, so therefore the Fed has to, and then I like to say, stop right there. The Fed has to do absolutely nothing about it. It is not the Fed's job. There are 435 members of the House and 100 members of the Senate and a president of the United States that need to deal with that problem, not the Federal Reserve. That's what they mean by fiscal dominance. We can't raise rates because it might impair the government's ability to pay back its debt or it might crowd out the sector. That's Congress's job. That's a message to Congress that you have to stop spending as much money. It's not a message for the Fed to say, we need to grease the skids so you can keep spending money like drunken sailors. I agree with the Fed. It is that fiscal dominance is not their concern. So when it comes to fiscal policy, Jay Powell is right to shrug your shoulders and go, you guys in Congress got a problem, deal with it. I'm not doing anything about it. Meaning I'm not going to cut rates and make your life easier. So they have to deal with it. And until they do, the amount of supply and the amount of concern that, fiscal spending, which is government spending, is usually inefficient and a form of artificial demand, which also does create inflation, will continue. So yes, it is a problem. Yes, it will continue to put upward pressure on interest rates. No, Jay Powell doesn't need to do anything about it. There's other people named congressmen, senators, and the president, and it's their job to fix this problem. And the market will continue to impose discipline on them until they fix this problem. Last thought for you. A year ago, we saw an example of this. Now, and it was an extreme example. In the UK, Liz Truss was the newly appointed prime minister, and she proposed what was referred to as the mini budget. And it was not a very Tory or conservative looking budget. It had tax cuts and it had increased spending and it just blew the deficit out. The market didn't like it, but the parliament didn't seem interested in the market's opinion. Okay, well then UK gilts went up 150 basis points in about 10 days. And the Bank of England has over 300 years of data that we've never seen the bond market in the UK blow up to that degree. We know what happened next. There was the meme that was going around that Liz Truss won't last as long as a head of lettuce, and after 44 days, she was out as prime minister. The mini budget was sacked. Rishi Sunak became the prime minister, and it created just a crisis and heartache and a mess. So if I say, Congress, you have to deal with it, the Fed's not going to deal with it, and Congress is, they can't even figure out who the Speaker of the House is, the bond market could blow up and blow up and blow up and blow up and force them to deal with it. What's my example of that? Last year in the UK, they proposed a budget that the bond market didn't like. The Parliament wasn't interested in what the bond market thought, and then the bond market made the Parliament interested in what it thought, and the Prime Minister was out after 44 days. So be careful when you look at these things and say that there's problems. The bond market can force itself on people, and we saw that last year in the UK.
Thank you. Well, I hope you may have more faith in Congress than I do at this juncture. I'm not sure.
I have faith that the bond market, when it's ready to, can focus Congress's mind. It's just not quite there yet. 5% is sort of starting, but when the bond market wants Congress, Congress, focus on this, and I'm going to show you how you're going to focus on it. It can do that. Now, I hope it doesn't come to that. I'd like to think that they're responsible, but then again, we are talking about Washington politicians, so maybe that's a demerit on me for thinking that I have hope in Washington politicians.
And thank you. And we'll go back to Keith. I want to talk a little bit about kind of the commodities markets in Canada. First, I wanted to talk about what are your thoughts on the effect of the current government's carbon tax? You already have food prices sky high. This seems like it will only make matters worse. Is this government going to realize this, or is it going to take new leaders to relook at this policy? And what effect is it having on the economy, on the real economy?
Well, I think it's creating a lot of memes. That seems to be the, the running joke these days with a lot of governments around the world. I like to say as well, whether it's in Ottawa or DC or over in London, in governments, I think they banned mirrors in all of the government buildings. They never look in the mirror to see themselves as maybe being the problem. So up here in Canada right now, for example, inflation, it's not only is it sticky, the thing, like central banks are trying to get the growth of inflation to come back down to this, this magical 2% number. But yet a lot of prices have increased by 50%. Prices have doubled in some products and services since the pandemic. And the idea of those prices going back to pre-pandemic levels, it's not going to happen. Like it's near 0%. So right now, what's happening in Canada is that the government, they're actually blaming the grocery stores for high food prices. So they're not blaming carbon taxes. They're not blaming any limitations on fertilizer. They're not blaming what's been happening with the supply lines, across the entire industry. They're not blaming more taxes on gasoline and so forth. It's always somebody else's fault. So within Canada, I think Americans, you have an election next year in 24. For Canada, it'll be a 25 event. But the government in Ottawa right now is quite weak across a lot of different polls. And if there was an election, that pendulum would swing pretty quickly from one side to the other. And Tracy, that then, in our opinion, that would then change dramatically. This approach, I guess the climate change policies that the Canadian government is taking. On the face of it, none of them make much sense if you compare carbon output of production by Canada relative to any other country in the world. But yet the government here is their number one goal. I received a flyer in the middle of the day for me to do a survey for our local member of parliament. And I had to, really rank the issues the most important to me. And the first one is climate change. And then the next one they offer is immigration, and then arts and culture. Like these are the things that they're focused on. They're not focused on the economy, to put it in that way. So back to maybe your question, I'm not sure if I hit it directly or not, but in Canada, the energy sector has had a black eye now for a while over the last maybe 8 or 9 years. And we believe in cycles. We think that story is going to come back in trend. And when we get into the next cycle, Canada will become attractive again from an energy and investment perspective. But we got to get through this, climate focused agenda government here at this point in time. I want to comment one thing on sort of the conversation that you and Jim were having a few moments ago. And it was all about fixed income world and duration risks. So, I mean, all the losses right now in the fixed income world is really from duration. And if you look at credit spreads, they haven't widened that much at all. And this will be the sort of called double whammy for bond investors. And so we manage money for families and individuals. We don't manage money for institutions. And I like to say that, institutions are insensitive to losses, whereas, mom and dads and everyone else, we are very sensitive to losses. And the industry tends to push the most conservative investors into the bond market, by default, especially with these target data funds and things like that. So if you're in that space and you've taken on anywhere from say a 5, -5, -15% losses now in some of your bond holdings, that's just from duration. Once we do see credit spreads beginning to blow out, and that's what we expect will happen, then you get that hitting fixed income investors as well. So I just think we're happen to be set up for this real difficult investment experience. And if you're not prepared for it, it is going to be difficult. And I know we're talking about equities there a few minutes ago as well. We don't have a big focus on valuation. We don't think that provides very good entry or exit points into markets. Instead, we put a lot of focus instead on trend and momentum. And a couple of our primary trend and momentum models for equities, they turned quite negative a few weeks ago. And that hasn't troughed out yet. So maybe the pain will be a bit longer here coming up. But again, we think it is going to present some opportunities there. But Tracy, back to the Canadian focus. Did that dance around a little bit what you're looking for?
Can
Yeah,
I
go
jump
ahead,
in and
Jim.
ask a quick question? You talked about the Ottawa government's not popular, and if there was an election, there would be a big change. When is the earliest that there can be parliamentary elections?
Well, Jim, it could happen this afternoon. So in Canada, we have a coalition government in power.
Then when is the latest that they have to call them? If Trudeau doesn't want to call them because he knows he's going to get skunked, when is he forced to call
It'll
them?
be in 25. So I'm assuming it's a fall event. So we're a couple years out.
Okay, and then Keith, back to energy for a second, since we were talking about that. So, what are your views on the oil patch right now in Canada? Can Alberta kind of disentangle themselves from the federal government? And then your thoughts on the LNG market in Canada. Is it too little, too late to make a huge difference?
I mean, first of all, the LNG market, again, Ottawa has not been friendly to the to the oil patch as well as the natural gas patch, if you want to call it that. So we've been late to the market in trying to produce liquefied natural gas and export it elsewhere. But you can catch up. If the proper investment is put into it and you're able to get approvals across a number of different policy groups, because there's a lot of groups that are opposed to any kind of development. And then, this will offer Canada a great opportunity. From again, if you know Canada or not, and again, it's just our thoughts on it, but Alberta is, everyone should know, it is the energy king for Canada. And they've been getting, the wrong end of the stick from Ottawa now for a number of years. And again, from a political perspective, that should start to swing in the other direction. So if you want to be bullish on anything in Canada from an oil perspective, go out to Alberta and hang out there for quite a bit. Oil, it is a global product. Unfortunately, we have a lot of it here, but we have to ship it, down to the US to have it refined and everything. So there are a lot of moves that can take place, but it's been stalled over the last 8 years or so. So the bottom line is don't give up hope on it. I think it is one of these great long-term opportunities for Canada, because otherwise, Canada has this barbell economy. It's always been energy and commodities on one end, and then the financial sector, with the other end. And as I mentioned earlier, the table is set for the probability of Canada experiencing something from an economic and financial perspective we haven't experienced before. And if that should happen, that would make the energy patch look even more attractive. We like that market quite a bit, Tracy.
Excellent. And then I wanted to ask about base and industrial metals, particularly in copper, why we're seeing such weakness right now, especially when, well, in copper, we're seeing all-time high demand in China. And we also have this green energy transition push. And so why do you think the metals are kind of lagging the energy sector?
I don't have a strong opinion on it, but I mean, the basic view that we have is because of global growth, it is rolling over. And, right now energy is getting the geopolitical premium attached to it, whereas a lot of the other base metals are not. So I can't give you a lot more view on that. Maybe Jim can chime in, or even yourself, Tracy.
I got nothing really on the base metals either.
And then, well, and this can be for either one of you before we do the final round, because we're coming up on the hour, even though I have still a million questions for you. I will definitely have to have you both back on again. But what are your thoughts on gold right now? And, is this just a reaction of geopolitical events, or is it sniffing out inflation or some other reason?
Do you want me to go first, son? Jim, do you like gold? I hear you don't like gold.
Yeah, I'll go first. The problem that the problem with gold is not that I don't like gold. I would like to like gold. Is that the financial markets have ruined it? I guess is really what it is. They've so financialized gold that it's become another currency. And when the dollar is strong, gold is weak, and when the dollar is weak, gold is strong. And part of the other problem I've always had with people telling me about gold is, like I said, the financialization of it. Oh, I want to buy gold because I think the world's going to go to hell. And okay, how'd you buy it? I bought some GLD. You think that's going to save you if the world's going to go to hell like you thought with gold? And then we've got derivatives on it. We've got futures on it, and the like. So what gold has become is another currency. And it suffers from the same problems that another non-dollar currency suffers from. The dollar's kind of movement really impacts it. Also, I'd say that gold suffers, at least at, when you start talking about the age groups, at the younger end, it has competition for another alternative in crypto, especially Bitcoin. If you're going to buy gold, let me back up. Gold is supposed to be the way that you say, I am worried about the financial system. Whether it's inflation or default or all of the above, what do I do to protect myself? Well, it's really hard to get your money out of the financial system, but historically the closest way was gold. Well, now that we've put futures and options and ETFs on it, it's so intertwined with the financial system, you have to wonder how much it works. So they turn to crypto and they say, okay, that's a way to get money out of the financial system. And that's why it also saps, I think, demand at the margin for gold as well. So I would like to be positive on gold. In other words, I would like it that we had a non-correlated alternative to the financial system. Historically, it has been gold. Gold has kind of been ruined by the financial system. And now it looks more like crypto. And if I was to give a warning to the crypto crowd, don't get too excited about the BlackRock ETF because you might be going down the same road. It's great for number go up in the short term that you're going to get a bunch of real demand for a spot ETF in Bitcoin. But if you want to fulfill the ultimate promise of what crypto is supposed to be, joining it at the hip to the financial system through an ETF might wind up doing to it what it did to gold. That's kind of my only little warning there.
Well, as a Canadian, we're required to have a view on gold at all times, Tracy. I think you know that. And so for us, we always have a core holding in bullion. It's not a significant weighting, but it's there. A lot of similar views about gold, what Jim said, but most importantly, we do not view gold as a hedge against inflation or deflation or anything else. It's really a hedge against everything hitting the fan. And it is our view that the probability of that happening over the next 18 months or so, it is rising by the day. So the longer term opportunity for appreciation protection from gold, we think it's quite positive. And so it's something that I think you want to be adding it to your positions, really when there's not a lot of talk about it and so forth. But for people to feel that, the current price of gold, it's way too high or too low, we think that's wrong. You have to appreciate why you hold it. And it is to protect you from some global macro events, which we feel the probability is increased that it may occur.
Thank you. And now for the final round, again, it's the same question for you both. We'll start with Jim. You could talk about something that you wanted to talk about that we didn't get to cover today, and or what should we as investors here be keeping an eye out on for, say, the next 12 to 24 months?
Oh, the first part of the question, 2009 to 2020 was the QE period. That was the abnormal period. Whenever I see people doing analysis of how much interest rates have gone up or how much real rates are higher, the breathless headlines I read that real rates are at the highest level since 2009. The implication there is the current level of real rates is wrong. No, 2009 to 2020 was what was wrong. This might be more approaching normal. And especially now that we're past the QE period. So when people think about what the yield curve means, the rise in rates, real rates, and the like, and then they say, well, they've gone up, the Fed's raised rates 500 basis points. Well, the first couple of hundred, maybe 300 to 400 of that might have been just getting to neutral, and the rest of that might be tightening, which is why the economy can handle these high rates. I know Jonathan Gray of Blackstone last week, in the process of reporting a lousy quarter, warned that 5% interest rates is going to crush everything, and that 8% mortgages are going to crush everything, and that rates have to come down. All right, since I dragged them out and criticized them, I'll go all the way. Did you build your business model on zero rates? And now that we don't have zero rates, as a levered private equity firm, you're really struggling with it. And just because you're struggling with it doesn't mean the entire economy is struggling with it. And that doesn't mean that interest rates have to go down. So 2009 to 2020 was the abnormal period. What you're seeing now is a return to normal. Maybe we've overshot. I mean, that's a subjective call. But even if we have, I don't think it's by nearly as much as the Jonathan Grays of the world think it is. What to look for in the next 24 to 48 months? I'll come back to a theme that we've heard here a little bit. I think top of the list is political instability, whether it's the Middle East, whether it's the 24 election, whether it's what we talked about with what's going on in Ottawa, and everything in between. I think that political instability is going to continue to be a problem. And given all of that, the place that I would put the political instability at the top of the list is China. I think that the biggest stress points right now are in China. Look at the stories we've seen this week. Google announced that they're going to make their Pixel phones in India. Well, they're just assembling them in India, and they're going to get all the parts still from China, but they're looking to globally outsource the parts. In other words, let me restate what I just said. Google wants nothing to do with China anymore. They want to get the hell away from China. Then we saw a story yesterday or the day before. The head of Foxconn, which is a Taiwanese company, has resigned from the board to run for president of Taiwan. And of course, we know the tensions that Taiwan is having with Taiwan is having with mainland China. And immediately, mainland China has now opened investigations of all of the Foxconn facilities that make Apple products and supply Apple products, mainly the iPhone. Okay, China, are you just begging Apple to leave now too? And so I think that when I talk about political instability, yeah, we know the Middle East. Yeah, we know that the election's coming up. But I think I would put on the top of that list China. China, last thought for you on China. They reopened. They reopened from zero COVID this year. If you go back and look at the Bank of America Global Fund Manager Survey, they've asked for 23 years, what is your outlook on China? January of this year was the highest that it had ever been in 23 years. And why? Because in January, they had lifted zero COVID. Everybody was, if you understood what was happening in China, and this is not a metaphor, they were literally welding the front doors of apartments shut so that people could not leave to prevent the spread of COVID. That all ended in January, and that was supposed to unleash a giant boom in their economy. It didn't. Their economy is barely growing faster than it did when they were in shutdown, and their stock market is under extreme stress. They are back to trying to jail speculators and putting together a government fund to buy stocks to support it, and it's still down 10% on the year. And that's after it was up 15% for the year back in February. So my biggest concern politically, and what I want to focus on more and more for the next 12 to 18 months, is the problems that are coming out of China. And it's not getting any better anytime soon.
I'm actually glad you addressed China because that was one of the questions I had for you that we didn't get a chance to get to. So I appreciate it. Thank you. And then Keith, it's same question. You could talk about something that you wanted to talk about that we didn't discuss or didn't have time to discuss, and or what should we as investors be particularly looking at, say over the next 12 to 24 months?
Yeah, sure thing. I think I just want to emphasize that the probability of the US dollar surging over that time frame is quite high. And it's not because of what's happening within the US, it's because of what's happening outside of the US, whether it's China or Canada or Europe. But it's our view that the likelihood of a hard landing in many of these non-US economies, it's increasing by the day. And when that's happening, it's going to start to be a little bit self-reinforcing at that point, and that capital will flow into the dollar, driving it higher, which means weaker on the cross rates. And then, for example, the probability of sovereign debt markets experience severe stress at some point, again, we think that's something investors should be aware of. So if that were to happen in Canada, for example, I would expect that Bank of Canada would rush in immediately to bail out the federal government bond market because they did it back in 2020, and then they even bailed out the provincial debt market as well. But when that happens, whether it's in Canada or the UK or any of the Eurozone countries, risk will then be expressed through the currency world, and so that's when you get that sort of self-reinforcing experience taking place, driving the dollar higher. So I think the main point for listeners to take away from what you're hearing today is that even though the world might be heading into this so-called awkward financial economic moment, there are ways to make money and to actually or preserve capital with what you have. But again, the opportunity for the dollar to do it extremely well. That's one of the views that we have, and we think it's a great way for people to protect themselves against some fat tail events that might come up.
Excellent. And I want to thank you both for giving us your time today. Really appreciate it. I know the listeners really appreciate it. Thank you for everybody that joined in the space to listen. Please follow these two on Twitter or X, sorry. They both post a lot of really great information. As always, follow Place Your Trades to find out what else they have going on over there. And again, I can't thank you gentlemen enough And with that, we will see you next Wednesday.